In September 2008, Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. The next day, the stock market lost $500 billion in hours. Within weeks, the global economy was in free fall. $10 trillion of wealth vanished. 8 million Americans lost their jobs. Millions lost their homes. It was the worst economic disaster since the Great Depression. But here's what nobody tells you. This wasn't an accident. This wasn't bad luck. This was the result of fraud, greed, and a financial system that had turned into a casino. So how did the richest country in the world nearly destroy the entire global economy? Let's break it down. The housing boom. Our story begins in the late 1990s. The U.S. economy was booming, the stock market was soaring, and interest rates were at historic lows. Banks were basically giving away money. Want to buy a house? Here's a mortgage. Don't have a job? No problem. Bad credit score? Who cares? House prices were going up. Every year, houses became worth more. People started treating homes like ATM machines, borrowing against rising values to buy cars, boats, whatever they wanted. The banks were making a killing. They'd give you a mortgage, collect fees, and everyone was happy. Except there was a problem. A lot of these mortgages were being given to people who could never afford them. These were called subprime mortgages, people with terrible credit, people with no income verification, people who were basically guaranteed to default. Banks were literally approving loans where people didn't prove they had a job. They called them ninja loans. No income, no job or assets. I'm not making this up. But here's the crazy part, the banks didn't care. Why? Because they weren't keeping these mortgages. They had a plan, a very, very stupid plan. The Wall Street machine. Here's where it gets interesting. And by interesting, I mean completely insane. Banks would take thousands of these mortgages, good ones, bad ones, terrible ones, and bundle them together into something called a mortgage-backed security or MBS. Think of it like this. You take 1,000 home loans, throw them in a blender and sell pieces of that blend to investors. The investors get paid when homeowners make their monthly payments. Wall Street loved this. Pension funds, hedge funds, foreign banks, everyone wanted a piece. Why? Because these investments were rated AAA by credit rating agencies. AAA means super safe, almost as safe as U.S. Treasury bonds. But wait, how can you take a bunch of risky subprime mortgages and turn them into AAA-rated investments? You lie. The credit rating agencies, companies like Moody's and Standard & Poor's, were supposed to honestly evaluate these investments. But there was a problem. They were being paid by the banks creating these products. If they gave bad ratings, the banks would just go to a competitor. So they gave AAA ratings to garbage. It's like having a restaurant pay the health inspector. You think they're gonna fail that inspection? But it gets worse, way worse. Wall Street invented something even more toxic. Collateralized debt obligations, or CDOs. These were basically MBS on steroids. They'd take the riskiest parts of mortgage bundles that nobody wanted, repackage them, and get them rated AAA. It's like taking rotten meat, grinding it up with some fresh meat, and selling it as prime steak. And then, I kid you not, they created CDOs made of other CDOs. CDO squared, CDO cubed. It was insanity. Nobody even understood what they were buying anymore. Meanwhile, investment banks were borrowing 30-40 times their actual money to make these bets bigger. If you had $1, you'd borrow $40 to make even more profit. Lehman Brothers was leveraged 44-1 when they collapsed. That means if their investments lost just 3%, they'd be completely wiped out. From 2000 to 2007, Wall Street made hundreds of billions in profits from this scheme. CEOs got massive bonuses. Everyone was getting rich. But the whole thing was built on a lie. And lies always collapse eventually. The cracks appear. In 2006, something changed. House prices stopped going up. And when house prices stopped rising, people with subprime mortgages started defaulting. They couldn't refinance. They couldn't sell for a profit. They just stopped paying. At first, Wall Street wasn't worried. A few defaults? No big deal. But then a few became thousands. Thousands became hundreds of thousands. Suddenly, all those AAA-rated mortgage-backed securities were worthless. The CDOs? Completely toxic. Nobody knew what anything was worth anymore. Banks started looking at each other and thinking, how many of these toxic assets do you have? And when banks don't trust each other, they stop lending to each other. When banks stop lending, the entire financial system freezes. By late 2007, banks were sitting on trillions of dollars in assets they couldn't sell and couldn't value. It was like holding live grenades with the pins pulled out. The question wasn't if something would explode, it was when. The collapse. March 2008. Bear Stearns, one of the biggest investment banks, collapsed overnight. They were sold to J.P. Morgan for $2 per share. A year earlier, they were worth $170 per share. Wall Street panicked. But the government said it was contained. It wasn't. September 2008, the worst month in financial history. September 7th, the government seizes Fannie Mae and Freddie Mac, the companies that guaranteed half of all U.S. mortgages. September 14th, Merrill Lynch forced to sell itself to Bank of America. September 15th, Lehman Brothers files for bankruptcy, $600 billion in assets, gone. The same day, AIG, the insurance giant that insured all these toxic bets, was hours from collapse. If AIG failed, every major bank in the world would fail with them. The stock market crashed. The Dow Jones lost 700 points in a single day, but this wasn't just an American problem anymore. Banks in Europe held these toxic assets. Banks in Asia, banks everywhere. The entire global financial system was interconnected, and it was all falling apart. Credit completely froze. Companies couldn't get loans to make payroll. The commercial paper market, where businesses borrow money for daily operations, disappeared. We were days away from ATMs not working, from grocery stores not being able to stock shelves, from complete economic collapse. The government had to act. $700 billion. That was the bailout price, TARP, the Troubled Asset Relief Program. The government would buy the toxic assets and inject money directly into banks. Americans were furious. The banks that caused the crisis were being rescued while regular people lost everything. CEOs kept their bonuses. Nobody went to jail. Meanwhile, 8,700,000 Americans lost their jobs. 6 million families lost their homes to foreclosure. Retirement accounts were cut in half. Show human impact. Empty factories, foreclosure signs, unemployment lines. The damage spread everywhere. Greece nearly went bankrupt. Spain, Ireland, Iceland's entire banking system collapsed. It took years to recover. Actually, some communities never recovered. So who was responsible for this disaster? The banks? Absolutely. They made predatory loans they knew people couldn't afford. They lied about the quality of their products. Wall Street? Definitely. They packaged toxic assets, slapped AAA ratings on them, and sold them to unsuspecting investors. They gambled with insane leverage. The rating agencies? 100%. They gave AAA ratings to junk because they were paid by the banks. That's fraud, plain and simple. The regulators? Yes, they saw warning signs and did nothing. They believed banks would self-regulate. Spoiler, they didn't. The government? Partly, they encouraged homeownership without proper safeguards. They repealed Glass-Steagall, the Depression-era law that separated commercial and investment banking. Even some borrowers? Sure, some people lied on applications. But let's be real, they were victims of a predatory system. Here's the thing that makes people most angry. After the biggest financial fraud in history, only one major banker went to prison. One. Not the CEOs of Lehman Brothers, not the executives who knew they were selling toxic products, not the rating agency officials who committed fraud. The banks paid fines, billions of dollars in fines, but that money came from shareholders and customers, not the executives who got rich from the fraud. The people who caused the crisis kept their wealth. The people who suffered lost everything. So what did we learn from 2008? Well, some regulations were passed. Banks have to hold more capital. There are stress tests. Some risky behaviors were banned. But here's the uncomfortable truth. The banks are bigger now than they were before the crisis. Too big to fail is still a thing, and we're already seeing risky behavior creeping back in. The 2008 financial crisis wasn't a natural disaster. It wasn't unavoidable. It was the result of greed, fraud, and a system that privatized profits and socialized losses. Wall Street gambled with the global economy and lost, and when they lost, we all paid the price. Understanding how this happened isn't just about history. It's about making sure it doesn't happen again, because the warning signs, they're starting to appear again. If you learned something today, hit that like button and subscribe for more financial explainers that actually make sense. Drop a comment. What financial topic should we break down next? Thanks for watching. See you in the next one.